Welcome to our latest energy market update. I'm Jitesh from Trident Utilities, and today I'll be covering the latest price dynamics, demand and the wider energy complex. The rate of price declines between the first two quarters of 2023 had slowed by 6%. The general price trend over the summer period has been range-bound, with the winter 23 gas contract keeping within a 60 pence per therm range. While strong confidence for the remainder of this summer season continues to remove immediate risk premium, the market has been exposed to periods of high volatility linked to supply-side shocks. Since the beginning of Q3 23, a stronger contango has emerged across the forward contracts, as asymmetric price risks for this winter period and beyond remain due to structural tightness in the global gas market. Demand reduction continues to remain a key driver in the lower price environment. Price resistance has been linked to strong declines in the gas demand across Europe. UK gas demand is currently 15% below the 6-month rolling average, with the strongest declines observed in domestic heating requirement due to warmer temperatures. Healthy renewable power generation also coincided with reduced gas for power demand, with UK industrial demand keeping around 50% below this time last year. The lack of Russian gas flows has led to increased global competition for LNG in a race to fill storages. Recently, the Asian LNG benchmark shifted into a premium against the European benchmark, with the current price spread sitting at $1.3 per MMBTU. This provides less incentive to exporters such as the US to deliver LNG to Europe, whereby flexible cargoes can be diverted to a higher price market. This has led to a 3 BCM drop in total monthly European LNG imports since April 23. The lack of rainfall this summer has dropped River Rhine levels to historic lows in the northern and central parts, which is pressuring transport logistics in continental Europe. This leads to limited load capacity to transport goods to refineries. The potential resurgence of gas demand in Asia from an El Nino event, which correlates to hot weather conditions along with reduced cold weather risk in Europe, could widen the price differential between Asian and European markets and pose supply risks. The combination of supply constraints and Europe's target to have gas storages 90% full by the 1st of November has led to European gas markets shifting to a premium against the UK. This incentivised higher net UK exports to support electricity generation in the EU due to France's high number of nuclear outages. The hydro balance in the EU is far below regular levels that may lead to increased usage of gas for power generation. Continued export demand leads to tighter domestic supply margins that could also add volatility to the prompt market.
Hello, I'm Alexandra Mottershead. I'm a risk manager here at Trident Utilities. Today I'm going to be covering the supply outlook for the coming months and closing the video with some recommendations for procurement for the next few months. LNG cargoes continue to arrive into Europe with frequency, although we have seen the number of cargoes arriving into the UK declining. Despite this, the UK has remained well supplied even through the recent period of heavy Norwegian maintenance. Norwegian oil and gas firm DNO recently made a significant gas and condensate discovery at the Carmen prospect, which was the largest find on the Norwegian continental shelf in a decade, holding 175 million barrels of oil equivalent. Asian LNG prices have consistently traded at a premium to European markets in recent weeks, although spot purchasing remains muted in the region. All eyes remain on Asian demand, as this is expected to pick up later in 2023 and could materially impact the amount of LNG Europe receives. Europe continues to bolster its LNG capabilities, with 7 floating storage and regasification units now in operation and 4 more planned by year end. Centrica has signed a 15-year agreement to supply the UK with LNG from America. The arrangement involves supplying 1 million tonnes of LNG per year for the next 15 years. The delivery is expected to be 14 LNG cargoes a year, with a market value of roughly $8 billion. CEFA recently signed a 20-year LNG deal with Venture Global LNG for 2.25 million tonnes per annum. However, Europe needs to secure more long-term LNG deals to reduce exposure to volatile spot markets, particularly if a ban on Russian LNG goes ahead. Whilst European carbon reduction policy could be one barrier to securing longer-term LNG deals, another is the fact that most new LNG capacity is already tied into longer-term deals. As a result, it's imperative that Europe diversifies its strategy for securing long-term LNG supply. One potential avenue is tapping into expiring legacy contracts. Globally, contracts totalling 93 BCM are due to expire in 2023. This route could offer more flexibility and access to immediately available LNG, since most longer-term SPAs for new projects are usually agreed years before gas is available for delivery. Remaining Russian gas flows into Europe have been steady in recent weeks, although Russia recently threatened to cut remaining flows via Ukraine due to ongoing litigation efforts by Ukraine's Naftogaz. Ukraine is suing for lost assets in Crimea and Gazprom's failure to ship the amount of gas stipulated in their gas transit agreement. Whether Russia would actually go ahead with severing this revenue source remains to be seen, but the existing gas transit deal between the countries expires at the end of 2024, so this could signal an end to flows via Ukraine from 2025. Gas storage levels in northwest Europe sit far above the 5-year average and could be on track to reach 95% fullness by September. UK storage is 50% full, but we expect this figure to improve from mid-July once flows return following Norwegian maintenance. Weather conditions for the remainder of summer will be key for gas storage levels as we head into the winter months. If heatwave conditions do emerge, both nuclear and hydro capacity could be impacted at a time of increased demand for cooling. Gas-fired power generation will be used to fill this gap, and with a further period of heavy Norwegian maintenance scheduled from late August to late September, gas storage could be called upon to meet demand. Available French nuclear capacity currently sits around 38 gigawatt, with almost 12 gigawatt of extra capacity online compared with the same period last year. Output is forecast to climb rapidly from late July to early September, when available capacity is set to hit 46 gigawatt. Any delay to the return of this capacity is a major risk factor heading into winter. France's nuclear fleet is ageing, and additional checks have been ordered across the fleet due to the discovery of thermal cracks at some plants. Delays to the maintenance schedule, or indeed these extra checks, could result in price spikes as we saw in December 2021.
In the wider energy complex, Brent is currently 8% below prices observed since the start of the second quarter. However, prices have generally been consolidating within a $10 per barrel range since the beginning of May 23. Currently, the market sits at the top of this range, hovering close to $80 per barrel, supported by extended voluntary supply cuts from Saudi Arabia, Russia and Algeria. If fully implemented, that would lead to a combined reduction of 5.36 million barrels per day versus August 2022 levels, and possibly more as several OPEC Plus countries are unable to fulfill their output quotas. Before these announcements, the IEA suggested the oil market is set to show a supply deficit of roughly 2 million barrels per day in the second half of this year. However, the overall commodity sector, including crude oil, is suffering from risk of adversity due to Chinese growth worries and strength in the US economic data, pointing to higher interest rates which could slow demand growth. The UK and European carbon markets experienced a high rate of divergence from April 23 to the beginning of June 23. The UK market was initially pressured by lower demand for permits, indicated by general weakness in bid-to-cover ratios. Meanwhile, EUAs continued to remain supported above the 200-day moving average on periods of reduced auction volumes, and the European Parliament approving a number of reforms from the EU ETS. The expansion of the allowances scheme to the maritime sector alongside phasing out of free allowances were amongst a plethora of changes. From this point, the build-up of net short positions, mild weather and additional auction supply from the Repower EU sales provided strong price resistance, in contrast to the UK market, now supported by a regulatory announcement signalling curtailed supply of allowances for the remainder of the ETS cap, and extending the emissions cap to additional sectors including waste management and domestic maritime support.
For customers with upcoming fixed contract renewals, given the potential risk factors for late summer, coupled with the usual September round rush, we would advise going to market as soon as possible with a view to fixing by late July or early August, as prices currently sit at the lower end of recent ranges. A flexible, progressive strategy solution remains the best tool to reduce the risk of purchasing in a high price environment. For larger energy users, this can be achieved with a flexible energy contract and comprehensive risk management strategy. For consumers who cannot access standalone flexible contracts, Trident's framework solutions provide a facility for purchasing energy flexibly with multiple strategy options for varying risk appetites. That brings us to a close on this update. If you have any questions, please feel free to contact us. You can also find the latest energy market commentary from our experts on the Trident Utilities website and social media platforms. Thank you for listening.